The kitchen is quiet, it's a Tuesday morning, and the coffee is already made. 2 cups, like always. Except you only pour one now. You've been doing that by accident for 3 weeks, reaching for the second mug out of habit, and every time it hits you all over again. You are a widow or a widower, and the grief is still so raw that you haven't had a single clear thought about money, about taxes, about what happens next. Because how could you? You just lost your person. But here's what no one told you. Here's what your financial advisor may not have mentioned. Here's what the IRS is counting on you not knowing. The moment your spouse died, the federal government quietly reclassified you, changed your tax status. And if you don't understand what that means and act on it before the deadline, you could owe tens of thousands of dollars more in taxes next year than you did last year, on the same income, the same Social Security, the same retirement withdrawals. Nothing changed, except everything changed. This is called the widow's tax penalty, and it is one of the most brutal, least talked about financial landmines in all of retirement planning. Here is the trap in plain language. When you are married, you file taxes jointly. You and your spouse share one combined tax bracket structure. The IRS gives married couples a wider runway before income starts getting taxed at higher rates. That wider runway is not charity. It's designed around the assumption that two people are living on that income together. When your spouse dies, that shared runway disappears. In most cases, you get one final year, the year of death, where you can still file as married filing jointly. After that, unless you have a dependent child living at home, you are reclassified as a single filer, and single filer tax brackets are dramatically narrower. The numbers aren't close, they're not a rounding error. For 2024, a married couple doesn't hit the 22% tax bracket until their combined income exceeds around $94,000. A single filer hits that same bracket at just $47,000. Half. The threshold is cut in half, and it gets worse at higher income levels. Same pension, same Social Security check, same IRA withdrawal. Suddenly, you owe more. And if your income pushes you high enough, and for many retirees with a deceased spouse's pension added to their own, it does, you can tip into the next bracket entirely. This is not a glitch, it is the law. And the people it hits hardest are often the least prepared to absorb the blow. Now let's talk about why this happens the way it does, because it isn't just the tax brackets, it's a cascade, a chain reaction of financial consequences that all activate at the same moment. You don't lose one thing, you lose several simultaneously at the exact point in your life when you are least equipped to fight back. Layer 1, the bracket compression. We just covered this, but what most people don't realize is how many income sources pile on top of each other in widowhood. If your spouse had a pension, that pension doesn't simply vanish. In many cases, especially with joint and survivor annuity options, you continue receiving a portion of it. So your income doesn't drop as much as you might expect. Maybe it drops by 20%, maybe 30%, but your tax bracket's dropped by 50%. You are now earning 3/4 of what you used to and potentially paying taxes at a higher rate. Layer 2, Social Security taxation. Here is where it gets even more damaging. When you were married, your household received 2 Social Security checks. Now you receive one, the higher of the two because of the survivor benefit rules. That sounds like a protection, and it is, but it creates a tax trap. Social Security benefits are taxed based on what the IRS calls your combined income. That is, your adjusted gross income plus your non-taxable interest plus half of your Social Security benefits. As a single filer, the threshold at which your Social Security becomes 85% taxable is just $34,000. For a married couple filing jointly, that threshold is $44,000. So you are now filing as single. Your threshold dropped. Your survivor benefit may actually be higher than the check you were receiving before. And suddenly, more of your Social Security is taxable than ever before. Layer 3, Medicare surcharges. This one strikes with a delay, which makes it particularly cruel. Medicare Part B and Part D premiums aren't set based on your current income. They're set based on your income from 2 years prior, when you were married, when your combined income was higher and your tax filing status was joint. The income thresholds for IRMAA, the income-related monthly adjustment amount, are, again, cut nearly in half for single filers compared to married couples. So if your combined income 2 years ago was, say, $180,000, you and your spouse may have paid standard Medicare premiums. But now, as a single filer at even $90,000, you may suddenly face Medicare surcharges of hundreds of dollars per month on top of your standard premium. The loss of your spouse triggers higher income taxes, higher Social Security taxes, and higher Medicare costs all at once, all while you are grieving. Let's make this concrete. Let's look at two widows. Call them Carol and Linda. Both are 70 years old. Both just lost their husbands in the same year. Their financial situations look almost identical on paper. Carol has a pension of $24,000 per year. Her survivor Social Security benefit is $22,000 per year. She also takes $12,000 per year from her IRA to cover living expenses. Total income, $58,000. Linda has the exact same numbers. The difference, Carol's financial advisor warned her. Carol knew this was coming and spent the year of her husband's death doing Roth conversions and tax planning. Linda did not know. No one told Linda. In the year after their husbands died, now both filing as single, here is what happened. Linda's taxable income after the standard deduction for a single filer sits around $40,000. She's now in the 22% bracket on a significant chunk of that. Her Social Security, $22,000, is 85% includable because her combined income exceeds the $34,000 threshold. Her total federal tax bill is roughly $4,800. The year before, filing jointly, her household's effective rate was far lower on the same income level. She is paying thousands more on an income that actually dropped. And because her income 2 years ago while married was above the joint IRMAA threshold, she now faces an IRMAA surcharge as a single filer, adding another $800 or more to her Medicare costs this year. Linda's total additional tax and Medicare burden compared to her final joint filing year, over $6,000, gone. In the first year of widowhood, Carol, who planned ahead, restructured her IRA withdrawals and managed her income below the key thresholds. Her additional tax burden was under $1,200, same grief, same income, very different outcome. So what do you do? What can you actually do, especially if you are reading this after a loss or planning ahead while your spouse is still alive? First, understand your filing timeline. In the year your spouse dies, file jointly if at all possible. That last joint return is a lifeline. Use it. Don't file separately. Work with a tax professional to ensure you capture every deduction available on that final joint return. Second, in the year of death, consider Roth conversions. This is the last year you will have joint brackets. If you have significant traditional IRA money, converting some of it now, paying tax at joint rates, locks in savings you will not have access to next year. This is a one-time opportunity. It closes the moment that tax year ends. Third, model your new single filer income before the year ends. Know what bracket you are landing in. Know whether your Social Security is going to become fully taxable. Know whether you are approaching IRMAA thresholds. You cannot fix what you have not measured. Fourth, review your IRA withdrawal strategy entirely. As a single filer, smaller withdrawals may keep you in a lower bracket. Required minimum distributions don't change based on marital status, but how much additional income you voluntarily pull from retirement accounts absolutely can be managed. Fifth, check your Medicare status 2 years out. Remember, IRMAA is based on income from 2 years ago. If your income this year is lower than it was when you were married, you can file an appeal with Medicare, called a life-changing event appeal, to request a reduction in premiums based on your current income. A death of a spouse qualifies. File it. Do not leave that money on the table. Sixth, if you are still married and reading this as a warning, plan now. Run the widowhood scenario with your financial advisor before you need to live it. The single best thing a couple can do is prepare for the tax consequences of losing each other while both of you are still here to make decisions. Here is the final truth. The widow's tax penalty is not going to show up at your door with a warning letter. It is not going to announce itself. It is baked into the structure of the tax code, quietly waiting for the worst year of your life to extract its payment. And the cruelest part is the timing. You are not going to be thinking about tax brackets the week after a funeral. You are going to be thinking about whether to keep the landline, whether to cook dinner for one, whether to move closer to your kids. The last thing on your mind will be filing status thresholds, which is exactly why you need to understand this now. Not after, now. The system does not wait for your grief to pass. Your first tax deadline as a single filer will arrive on schedule, indifferent to your loss, demanding its share of an income that already feels like half a life. Protect yourself. Talk to a tax advisor, not just a financial planner, an actual CPA who specializes in retirement income, before the calendar year closes after a loss. If you are married, do this conversation now, together. Save this video somewhere you can find it. Send it to someone you know who has recently lost a spouse or who is planning for that possibility. And subscribe, because every week we cover the financial traps that no one warned your generation about. You've worked too hard. You've saved too long. Don't let an invisible rule in the tax code take what your family deserves.